It's a great pleasure for me to welcome Tom Zimmermann to our finance research seminar. And Tom is professor for data analytics in economics and finance at the University of Cologne. And he has done and does research at various institutions around the world. His research is devoted to bridging causal inference and machine learning methods with applications in finance and macroeconomics. And he has published his research in outstanding journals such as the Journal of Banking and Finance, the Journal of Financial Economics, the Journal of Monetary Economics, and Critical Finance Review. And today he presents his paper and also outstanding project, open source cross-sectional asset pricing, which he worked on with Andrew Chen, and which is forthcoming in the Critical Finance Review. So without further ado, the stage is yours, Tom. Thanks.
Thank you very much. Thank you for the nice introduction and thank you for the invitation. Looking forward to presenting to you this project that Andrew and I have been working on for a while and that we hope others can benefit from. So it's called open source cross-sectional asset pricing. Let me start with some motivation. It's a popular question in finance. I guess don't have to tell an audience such as this one that very popular research question is what drives expected cross-sectional stock returns. And there have been more than 300 variables in the literature that have been documented. And some of them are very familiar to you, like firm size, past returns, momentum, and reversal, book to market. But there's also a whole bunch of other variables such as firm complexity and accrual variables that have also been shown to be related to expected stock returns. Here's like an overview from a paper by Kem Harvey and co-authors from 2016, where they surveyed the number of signals that have been discovered in the literature, and you can just look at the green line, which is the cumulative number of factors. So also let me immediately say that people are a bit vague about what is a signal, what's a factor. I will use these terms interchangeably. And you can see here the green line amounts to 240 factors that they surveyed in this paper over time. Others have surveyed a bit more. Overall, there's like I think around 300 that have been documented. How can there be so many variables that explain stock returns? It's a bit unusual if you believe in the efficient market hypothesis. One explanation is that this could just be risk. This could be compensation for risk. Possible that you make high expected returns, but also you have high variance. And for some of these variables, that's certainly true. Momentum has fat tails. So for some variables, risk might be an explanation. Another explanation might be mispricing, but then immediately you might want to ask, can markets really be that inefficient that there can be so many variables that explain cross-sectional stock returns? Or is it just a statistical problem of p-hacking? That there's like so many variables that people can test, and then some of them will come out as significant. These are three potential explanations. The literature is, let me, before I get into what the literature says about this, let me pitch this into like a more general framework of a model of how one can go about establishing new results. This is from a paper by Ioannidis, 2005, where he shows in a sort of a toy model that a research finding is less likely to be true when the effect size is smaller, when there's a greater number and lesser pre-selection of tested relationships, and when there's great flexibility in the designs and definitions. And when you think about this, it's all true for cross-sectional asset pricing. The effect sizes are relatively small. We do not believe that there's one variable that has a super high expected return. So all these variables will have relatively small expected returns. There's a ton of variables that you can use to find such a relationship between some predictor and expected returns, like from fundamentals to earnings to more exotic data sets. Then there's great flexibility in how you establish such a relationship. So you can run a univariate regression, you can run a multivariate regression, you can do portfolio sorts. So you have like lots of flexibility of how you go about establishing your research finding in cross-sectional asset pricing. So what does the literature actually conclude? The same Harvey paper that I mentioned earlier says that most claimed research findings in financial economics are likely false. And then there's two other papers. The Cordia paper says that the expected proportion of false rejections is about 45%. And then there's the Hu Zhu Zhang paper that made some waves that says that they cannot replicate 43% of documented stock return signals in microcaps and with equal weighted returns. Okay, so the literature is relatively pessimistic about the findings that have been established. What we do is we examine more than 300 anomalies from 154 papers, and we do find that 98% of predictors that we call clear can actually be reproduced. And when we provide further support from monotonicity and post-sample analysis, that these are actual findings, that this is not an artifact of just statistical data mining. On the other hand, the Hu Zhu Zhang paper is an artifact of investigating many anomalies that have never been shown to predict returns in the first place. So they claim that they have this very large data set of more than 400 anomalies that they examine. When we go back to their paper and then go back to the original papers, we find that a lot of the anomalies that they call anomalies have never been claimed in the original papers to be an anomaly in the first place. And I discuss this in a bit more detail later in the talk. Should you be skeptical of our results given the literature? Of course you should be. But what we do is we make the datasets available for download, and we also make the entire code available via a collaborative platform, GitHub, so that you can transparently see what we do, and you can also work with the datasets. So I think one of the, or maybe the main service of the paper is that we provide code to generate all these signals, and also if you don't want to dig into the code, we also provide benchmark datasets similar to the kind of French database, but for like an entire for the entire universe of predictors that are part of our study. Okay. All right. So how do we go about reproducing such a large set of anomalies or predictors? The starting point is a superset of anomalies that are cited in these 4 meta-studies, in the Harvey paper, and McLean and Pontiff paper, Green-Han Zhang paper, and the Hu Zhu Zhang paper. Here, this is from some work in progress. This is a citation network across all these anomalies, or a subset of those. I found this relatively interesting. You do see kind of like one hub here around Pharma French papers. You do see a hub around momentum papers over here. So momentum papers are here, values more over here. Those kind of neat that you do see these very prominent papers, and then many sort of adjacent papers that cluster around these prominent papers. Okay. So from all these, from the superset of anomalies, we impose 2 restrictions. For our analysis, we focus on individual stock characteristics. So that means that we exclude many of the signals in the Harvey paper that target portfolio returns only. And then we have imposed the restriction that the data have to be widely available. So for instance, there's one paper, Fang and Paris, that shows that media coverage predicts returns. And to establish that relationship, they access like a newspaper database that is not easy for us to access, and you know, we could probably do it, but then we could only use it for one signal, so it doesn't really pass the cost-benefit test here. So that's why we exclude a handful of papers that use very exotic data sets. The data that we use, main data sets, will be very familiar to you. Use CRISP for daily monthly returns, distributions, acquisitions, dividends. I use CompuStat for firm fundamentals. Copy stock pension data as well, the business and customer segments for firm complexity, use S&P rating data. We use IBIS data to get information on analyst earnings estimates and recommendations. And then we use a whole bunch of other data sets for various signals. We use the 13F data for various signals related to institutional ownership, or we use option metrics data for option-related signals, IPO dates for the Ritter signal, pattern citation data, macro data from Fred, and a bunch of others. The longest time span in our data set is from 1926 to the end of 2020. So this is what was available at the time when we finished the draft that is now going to be published. But we plan to extend the data set to 2021 sometime this spring. The primary key in the data set is the stock month. So this is a data set at the monthly level for each stock. Okay. I think one of the things that took a lot of time next to coding up all these signals was actually reading all these papers in detail and classifying them and figuring out what is actually the evidence that is provided for return predictability in these papers. Here's just a snapshot from an Excel sheet that we also provide, where we collect from each of these papers. We collect for each signal the return estimate that is provided in that paper. This could be a long short return from decile long short portfolios or quintile portfolios, depending on what is the main result in the original paper. And then we also collect the t-stat associated with that long short return in the original paper. We also provide the source here for which table in the original paper provides that key information. We have a subjective classification of original predictors into 4 categories: clear ones, likely ones, not ones, and indirect ones. And this is a subjective judgment call. Let me tell you what these categories are. A clear signal is a signal where we expect in our application a significant mean return in a long short portfolio. So what are clear signals? Clear signals are signals where we, in the original publication, see a t-statistic of above 2.5. The portfolio sorts are monotonic with at least 80 basis point spreads, or in the multivariate regression, coefficient on such a predictor has a t-stat of at least 4. That's just our subjective definition. We have likely predictors where we expect borderline significant mean returns in our application. These are predictors where the t-stat in the original paper is around 2 in a long short portfolio, or the t-stat is between 2 and 3 in a regression. Yeah. There's also, interestingly enough, there's also around a dozen predictors in the Hu Zhang paper that are actually where the original paper actually shows that that this variable does not predict the return. So the t-stat is, say, 1.5 in a long short regression, or the t-stat is around 1 in a long short portfolio is 1.5, and then in a regression is around 1. So the original paper here does not provide any evidence that this variable predicts returns. Then there's the indirect ones, and the indirect ones is a very large category in the Hu Zhang paper. It's not clear what to expect here, because these predictors have not been investigated in the original studies. Sometimes they're modified versions of an original characteristic that has been examined. So, for instance, an original paper might look at data at annual CompuStat data, and then the Hu Zhang paper also includes like a quarterly version of that. We say this is an indirect. This is a very simple example where you would expect the relationships to still hold, but it's still a modified version of the original characteristic. So some of these some of these will be relatively close to an actual predictor, and some of them will be relatively distant. So some of them will be just an ingredient of an actual signal. So some of these signals in the papers are composite signals of a bunch of different variables. So for instance, the Piotrowski score has like 9 different ingredients, and if you look at all these different parts of the ingredients separately, this is not what the original paper examined, but this is something that is part of the Hu Zhang paper. Okay, so these are the 4 categories, and yeah, just let's keep those in mind. Here's our data set. Let's focus on the first 2 columns. This is our data set. Predictors is what is everything that we classify as clear or likely. This is what we call a predictor. So this makes up 205 different variables in our data set. And then there's in the extended data set that we also make available, we include these 40 not predictors. There's really no reason you would want to include them other than for completeness. And then there's these 100 indirect signals that have been examined in other papers, mostly the Hu Zhang, but that have not directly been shown to be predictive of future returns. Okay, and this is how we compare. So the next 4 columns show how we compare to other meta studies. You can see that most of the indirect signals we only include to cover the Hu Zhang paper over here. Yeah. Overall, the coverage of our data set is such that we cover basically everything that is covered in these data sets as well, with the exceptions of the variables in the Harvey paper that the target portfolio returns only. Yeah. Okay. So all the results that I'm going to show you, most of them will be based on our predictor data set of these 205 predictors, and then we also look at some results in this extended data set of 319 predictors. Just a quick word on how we construct portfolio returns. This is the standard. I think this is a standard approach. We use firm level signals available in month T to form portfolios that we then hold for 1 month and evaluate the month T+1. So this is a buy and hold portfolio that we hold for 1 month. For continuous signals, we use a zero investment portfolio that goes long the highest quintile of the signal and goes short the lowest quintile of the signal. For binary signals, we go long the ones and we go short the zeros. If the original study is different, then we follow the original. So in some studies do not examine quintile as their main result, but deciles or terciles, then we do that as well. Yeah. But this is going to be our benchmark data set that we make available. But we also make available data sets beyond the original studies. So we also make available data sets that rebalance not at the monthly level, but at the annual level or at the quarterly level. We make available another data set that screens for liquidity first. So only looks at liquid stocks. We also have, in addition to the quintile data set, we have a decile data set. And we have a evaluated data set. Most of these predictors in the original papers are examined in equal weighted portfolios. Okay, so what do we find? So here's some good news for cross-sectional asset pricing. What you see here is on the x-axis the number of predictors, and on the y-axis you do see different data categories, and then the bars show you how many of the predictors in each category have a t-stat of above 1.96. And you see that for the accounting category, yeah, this is where most of the predictors come from, accounting and the price. Yeah, you do see that almost all of them have a t-stat of above 1.96. Yeah, and then there's like a few, only a few exceptions in the institutional holdings category. There's one, and then there's I think there's another one in accounting and one in price, where we're not able to get to a t-stat of above 1.96. This is the t-stat on the mean strategy, the long-short return. Yeah. Another way to show replication success is, I think, with this graph, where, remember, we hand collected the t-statistics from the original papers. And this is what you see here on the x-axis. And on the y-axis, you do see the t-statistic of our reproduction. And as you can see, these line up overall pretty nicely. So here you do see each dot here is one predictor. And what you see here is our t-stat against the t-stat of the original study. You do see that the clear ones, these are the solid dots, pretty much line up all around the 45 degree line here. Yeah, when you test, when you can test for the intercept being equal to 0, slope being equal to 1, and that cannot be rejected. And then you see the likely ones around here. And then there's like only 2 that we couldn't really replicate very well, the activism variables. But yeah, we have tried a lot, but haven't gotten to higher t-stats here. All right. Now let's look at the different categories, the 4 categories that we defined. Again, look at the t-statistic here on the x-axis. And the dashed line is at 1.96. Of the clear predictors, almost all of them, for almost all of them, we find the t-statistic of above 1.96. When we reproduce them, for the likely ones, remember the likely ones are the ones where the evidence in the original paper is not super strong, with a t-stat of around 2 in the original paper. So small deviations between the original paper and what we do can probably impact the t-statistic quite a bit to fall to the left or the right of the 1.96 threshold. So there's a lot more here that have low t-stat. The indirect signal category, these are the ones that, remember, these are the ones that have not been shown to predict returns, at least not directly. There's actually a bunch, about half of them, that predict returns pretty nicely. And then there's another half of them that have low t-statistics. And then there's the set of 14 variables that have been shown to not predict returns. And for almost all of them, we also find low t-statistics. So we do call this a replication success as well, right? Because we do find low t-statistics for the 14 variables or the 13 variables that have also not been shown to predict, that have been shown to not predict returns in the original publications. Comparing to the subset of predictors that are in the Huzhou Zhang paper. The Huzhou Zhang paper investigates lots of clear predictors, lots of likely ones, but also some of the not ones and many of the indirect ones. And as you can see here, all the clear predictors in the Huzhou Zhang paper actually reproduce, and the failures, the ones that have low t-statistic, almost all of them come from the indirect signal category, where the original paper has not examined the variable directly. We also compare this to the McLean and Pontiff paper. McLean and Pontiff, you see, yeah, it's somewhat smaller data sets, only 97 predictors in the data set. Almost all of them come from the clear and likely category, with a few of them from the indirect signal category, and one is a not predictor. Yeah, we replicate basically their finding that around 12% of the predictors have low t-statistics and the rest have relatively high t-statistic. We have another nice validation of McLean and Pontiff. As you can see here, not sure how familiar you are with this paper, but the paper is about publication bias and in cross-sectional stock returns, and how you can measure that. What they plot in their paper is, on the x-axis, decline in returns post-publication against the in-sample return in the original sample period. And what they show is that the higher the in-sample return, the larger is the decline post-publication. The solid dots here in the graph on the top are the signals in McLean and Pontiff, and the solid line is the regression line that is fitted in their paper. And the triangles are other variables that we added to that plot that are not McLean-Pontiff, but that could very well have been in that paper. And you see when you add those, the relationship is basically the same. So even in this extended data set, we do find that the larger the in-sample return in the original publication, the larger is the decline in return post-publication. And the same relationship holds for in-sample t-statistics. The larger the t-statistic in the original publication, the larger the original sample period, the larger is the decline in return post-publication. Okay. Now that we have this nice data set, we can do a bunch of things. For instance, we can look at how different liquidity filters affect return results. So here, what you can see on the y-axis is the mean return of different predictors. So each dot here is the return of one predictor. This is monthly return in the original sample periods. And what you see here is a box plot, and the solid line in the center of the box is the median return. So this here is around 55 basis points in the original papers, in the sample of original papers. When you screen for stocks that have at least a stock price of 5, the return goes down. The return is then only something like 45 basis points per month. When you screen for stocks that are listed at the New York Stock Exchange only, the return is even a bit lower, and the median return is a bit lower. When you screen for stocks with market equity above the 20th percentile of New York Stock Exchange, the return is also a bit lower than in the original papers. When you look at value-weighted returns only, or when you value-weight all the signals, you also get lower returns than when you do what the original papers do. And remember, most of the original papers do equal weighting. Yeah. So overall, these liquidity filters reduce the mean returns by about a third. We can also look at different rebalancing frequencies. So here it's the same idea. On the y-axis is again the mean return in sample, and on the x-axis we rebalance at different intervals between 1 month and 12 months. And overall, as you can see here, higher rebalancing frequency is associated with higher mean return. So if you rebalance only annually, this reduces the mean return by about 20% relative to 1 month. And this is, this is probably what you would expect. But if you think about trading, you would also need to take into account that higher rebalancing obviously comes with higher transaction costs in the first place. All right, so far for some of the results, I hope this gives you a bit of a feeling of what one can do with the data set that we provide. So how do we imagine the open source collaboration? You can access the entire project here at openassetpricing.com, where we provide some documentation on the data, on the code. We link to the code. We also try to keep a list of studies that use our data. We also provide some answers to frequently asked questions here. Code can be accessed on GitHub. This is where we have the entire code. You can look at how each individual signal is constructed, how we deal, how we process all the data sets that we use. So I hope this is going to be useful. If you're not familiar with GitHub, I think one of the nice things is that it allows transparent versioning of the code. So you can see different versions of the code and how they have evolved over time. You can see the changes that we've made over time to adjust some of the signals. And there will be more of those changes in the next version. You can also file so-called issues, where you think, oh, this is something that we should fix or that we should work on. And then you can transparently track the kind of issues that are open, the kind of issues that we have worked on already. And we hope to address many of the open issues. There's not that many. I think perhaps there's currently a handful of open issues. So you want to address them in the next iteration of the database this spring. try to discipline ourselves to like a software like release management, where we currently are at release 1.1.0, which is the version that released in April last year. And you can see the updates that we made from one version to the next, just like any other software that you probably use. Okay, if you see this and you think, oh, this is great, how can I contribute? The next big update for the database we plan for spring 2022. If you want to contribute, you can, and you are an expert in particular signals, you can review the code that we wrote to produce some of these signals and check whether what we did is correct. Or you can suggest improvements of how one can do this differently. We also plan to include a bunch of new signals in the next version that we haven't included so far. But we will need your help to find out which signals we have missed so far. So currently we plan to include a trend factor variable as well. The one suggestion that we got, and then we survey with the literature regarding other signals that we should also include. But if you have suggestions for us of what we should also include in the next version, let us know, and then we try to include that as well. All right. So far for the open source asset pricing project, and then I wanted to show you two applications of what one can do with the data. First one is another paper that Andrew and I have written and published already. As a paper about publication bias. And the question is, how large is publication bias? And one simple estimate to get a first measure of publication bias is the following idea. That is not our idea. This is from the McLean and Pontiff paper. So from experience, you probably know that the publication process is often long and painful, and there can be a lot of time can pass between the analysis of your data and the publication of your paper. And what the McLean and Pontiff paper does, it looks at the first of all looks at the in-sample return data. So here, so in-sample, say the mean return is 68 basis points. And post-publication, when you look at what are the mean returns of these signals post-publication of these papers, it's only 27 basis points. But it's much lower. And you could attribute this to publication bias. It's like, oh, the people have really tuned the return such that it is very high in the sample period, but then it all collapses post-publication. It's not entirely correct though, because in asset pricing, this could also be a trading effect, that people start trading on the anomaly and this just disappears by people trading the anomaly away. So this would be an overestimate of publication bias, comparing the in-sample return to the post-publication return. But the length of the publication process offers provides an opportunity here to get another estimate that might be less polluted by trading effects, which is the time window between the end of the in-sample period of your data sample and the publication date. The idea being that in between, people are less aware of the signal, so they don't trade on it. But the in-between period still provides an estimate of publication bias, because the return decreases here, is now 46 basis points, so it's much lower than the in-sample return. Is much higher than the post-publication return. And the idea is that this in-between return can be used as an upper bound on publication bias. Say it's an upper bound because obviously this also includes some trading effects. Right? Traders will also will not only look at publications, but will also look at working papers and probably start trading on working papers as well before publication. Okay, so this is why it's an upper bound. What we do in our paper is we we provide and estimate a structural model of the publication process to tighten this upper bound. Can't go into all the details of that model today, but the idea is that we can estimate the structural parameters from the distribution of observed t-statistics in the data. And what we then find is that publication bias is relatively small. It's on average only 12% of the in-sample return. So that means that if you see an in-sample return of 1% per month, then you only need to reduce this by 12 percentage points to get to the publication bias cleaned in-sample return. The model is very simple. The idea is that I have that the return for a particular predictor is drawn from a distribution of returns, and the mean of that distribution is also drawn from a distribution of the mean returns. And what we do is essentially we shrink the in-sample return to the overall expected mean return. The question is just what is the weight that you should put on the overall mean relative to the in-sample mean that is provided by a paper. This is an old estimator from the 60s. It's known as the James Stein estimator. The publication probability we model just as in John Cochrane's paper. So publication is positively associated with higher mean returns, lower variance. So these are also parameters that there will be parameters here that we estimate. And then the weight, the weight that we put on the in-sample return relative to the overall return, this is identified from the dispersion of the published t-statistics. Okay, so this is here you can see if we pick like a very small dispersion of published mean of published t-stats, you see that the model doesn't fit very well. If you pick like a larger dispersion of mean returns, the model fits the observed distribution of t-statistics very well. So the main intuition for our finding is that there are a bunch of predictors that have been documented in the data with very high t-statistics. To get such very high t-statistics, you do need a lot of dispersion in true mean returns. And that leads to a relatively small shrinkage factor for the publication bias. Okay, here's one way to show you publication bias for these different signals in the data. Here what you can see is on the x-axis you see the shrinkage, or how much you should shrink the in-sample return relative to the in-sample, the published return relative to what it actually should be. And you see that there's a bunch of, or a large chunk of signals that you do not need to shrink very much, only by 0 to 5%. Then there's a bunch that you need to shrink a lot more, that you need to shrink by 30 to 40%. These are mostly variables that have relatively high return volatility. So the variance is relatively high. Okay. But on average, the publication bias is only 12%. Okay. So there's one application for the data set. Here's another one. There's another, I think, very important question is how can investors incorporate information from academic studies? So now that there's so many, how can we include all these variables in for portfolio allocation? And the two leading approaches, I think, are first, you can use all these signals to predict expected returns. So here I have a model of expected returns where I predict the return next month as a function g, which is a very flexible function of past returns and other variables. And I have a paper from that's a few years old that uses a so-called random forest model to model this function g. And there's the Kelly and co-authors paper from 2020 uses also random forest boosted trees and neural networks. So basically examines different machine learning models to model this function G. Now this helps you to get some estimates of expected returns. Another leading approach is you can maximize the expected utility of an investor directly. So the utility of an investor depends on their portfolio return in T+1, and their portfolio return is just the return of the individual assets with a weight on each asset. And what you need to model is the weight, and the weight is modeled as a function f, and f depends on can depend again on past returns and on fundamentals of these companies. All right, and this is the approach that is introduced in the Brandt 2009 paper. And what we do in current work is we combine these two ideas. So let me show you how we combine this. So this equation is the same as on the previous page. This is also called the parametric portfolio policy problem. And in the original Brandt paper, this function f here is just a linear function with a small number of signals, with 3 signals. So there's 3 parameters that I have to estimate. The De Miguel 2020 paper, which is a paper about the transaction costs, models f also as a linear function with some shrinkage and with a larger number of signals. I think they have around 50 signals here. And the shrinkage, I mean, they use a version of the lasso estimator here to estimate f. What we do, we model f as a feed-forward network with even larger number of signals. And I say this combines basically these two approaches because it allows for interactions and nonlinearities in the function f very easily. We can also use different utility functions easily, and we can control portfolio leverage and individual assets weights very easily. So I think it's kind of a neat way to introduce feed-forward networks into the parametric portfolio policy problem is here via modeling of the weight function f. Okay, so here's our weight function, and here's what our f looks like. So our f is a feed-forward network that has 5 hidden layers with 32, 16, 8, 4, 2 nodes. So this is a very simple structure that's also used in the Kelly paper. Some details. I think don't want to go into technical details, or if you want, we can. As activation function, we use a so-called exponential linear unit that doesn't suffer from a vanishing gradient problem. The way we estimate a model is we start with 10 years of training and evaluate on the next 5 years, and then keep coefficients fixed for 1 year to invest, and then we roll forward everything by 1 year, and then we estimate a model again, update the coefficients, use the model again for 1 year of portfolio allocation, and this is how we evaluate our expected utility out of sample. We have some results. This is really very preliminary for the constant relative risk aversion case, but we're also working on other utility functions here. And here, what you can see is over time, time is on the x-axis, you see the per period utility of a equal weighted portfolio and the value weighted portfolio. So equal weighted portfolio is just the 1/n portfolio. This is the utility, is the red line over here. And then you see the blue line, which is the parametric portfolio policy problem with the linear f. The linear f kind of tracks is much higher expected utility than the equal weighted portfolio. Then if you use the feed-forward network parametric portfolio policy, we do see that the per period utility is again much higher than the equal weighted or value weighted portfolio, but also significantly higher than the parametric portfolio policy with linear weighting function. Okay, currently we're working on getting more insights into the model. I will show you one thing is basically if you vary the coefficient of risk aversion here from 2 to 10, so 2 is the blue bars, blue bars here are the low risk aversion of 2, and the gray bars are higher risk aversion of 10. And then what you see here is the impact of these different variables in the model. And one quick thing to take away from this graph is that the higher the risk aversion, the more variables you want to include in your model with positive weight. Yeah. So I guess that's one intuition. I think it's quite natural that the higher risk aversion is associated with more variables in the model because it provides some diversification benefit. Okay. All right. All right. So that brings me already to the end of the slides. So let me just summarize the open source cross-sectional asset pricing paper. So we reproduce the stock return anomaly literature with the most comprehensive set of signals. I hope I convinced you that that's the case. Almost all the clear signals can be reproduced in sample. So I think that's a success for that literature. Code and data are available, and please check it out and let us know if there's anything we can do to make it better. Also, if there's any signals that you think we should include in the next version, let us know as well. We plan to work on this in February and March. So now is a perfect time to send us updates that we should include. All right, that's it for me. Thank you very much for your attention. I'm looking forward to some discussion.